Breaking news on Business Television India, the numbers that we were waiting for within the banking space, the big one, ICICI Bank numbers are out. That is coming in at 1,020 crore rupees. That stock ended 2.5% up ahead of those numbers, at 289 rupees a share. And right now we're looking at the PAT number, which has come in at 1,020 crore rupees. It was seen at 1,076 crore rupees. So not very much off the mark, as it were. Clearly, of course, as far as hits are concerned, it was expected to be a not too strong a quarter as far as ICICI Bank is concerned. And NIIs were seen at 5,854 crore rupees. That was the expectation. I'm waiting for all those numbers to come in now. We're looking at the gross NPA number as well, and PAT, which has come in at 1,020 crore rupees. This is the fourth quarter of ICICI Bank that we're looking at. Several factors to watch out for as far as profitability goes, asset quality goes, and indeed the impact of the RBI circular on the reclassification of the stressed assets. But Piyush is here to walk us through the kind of numbers that we're seeing. A gross NPA coming in at 8.84%. Piyush, what do we have now?
Well, Vikram, again, it looks like if you look at the numbers again in terms of the bottom line number, the net profit expectation was 1076 crores, which implies that almost a fall of 47%. I think the bottom line number which actually has come is now again almost at 1020 crores. So again, I should say it's a miss of almost 5% here on the bottom line here. So again, that's the first take coming here. Now, if I look in terms of segmental performance, before again we start talking about NIMs and the NPA ratios here, I think the first I think is coming from the segmental numbers, and that basically is in terms of retail banking again. There has been good growth in terms of the retail banking profit before tax and monetary interest. So retail banking basically has grown. Wholesale banking, there are sharp losses again. Primarily it was expected because there was the expectation of higher provisioning because of RBI circular, and also the way again it should have been incorporated. So wholesale banking again, there is a sharp dip here. Now let's look at some headline numbers in terms of growth again. The first of all, again, what it looks like, loan growth at 15%. So again, this actually looks better than what the street was anticipating. In terms of CASA, again, that's around 51.7%. Core operating profit, again, that's before provisioning, again, that number actually has come at almost 18,940 crores. That's a full year figure for 2018 here. But broadly, again, loan growth of around 15%. Retail loan growth around 21%. Last quarter, it was 22% growth about again. So again, a similar sort of performance on retail loan growth. If you take a look at the overall loan growth, again, that also looks good. Now, in terms of NPAs, again, basically, that's the headline number here. 15,737 crores, that's the gross new slippages again, which actually has happened in this quarter. And this includes 9,968 crores. Again, those again were under RBI schemes, S4A, restructuring, all those schemes basically now again, there's fresh slippage. Now remember again, the street was anticipating that because of RBI circular, fresh slippages could be around 10,000, 11,000 crores. As in this number is higher than what the street was fearing about. So perhaps this number could be higher than about 3,000 to 4,000 crores here. So fresh slippages actually is much more than what the street was expecting. Now very interesting again basically is recoveries again and upgrades. There have been a couple of recoveries again, so around 4,000 crores basically is a recovery. Provision coverage ratio around 60.5%. That should please the street here. 60% again is normally a good number here. Now also in terms of notes again, what actually has come out is bank actually has classified 3 borrower accounts in the gems and jewelry sector as 794 crores, about 795 crores as fraud and NPA accounts here. We know actually the exposure would be also pertain to the Gitanjali Gems and Nirav Modi case here. And also the provision of 290 crores about has been provisioned through P&L account here, and also 500 crores about through the balance sheet here by debiting reserves here. So again, fresh provision of about 290 crores coming from the jewelry sector. The provision again is coming from there here. So that's something really significant here. In terms of net interest income, NII figure again basically has come for the fourth quarter around 6,022 crores. So again, this is roughly a growth perhaps. And the good point here is what I should tell. is the street was expecting a fall in NI by about 1.8%. What ICICI Bank has delivered is actually a growth in NI versus a fall here. So this is almost a 4% increase in NI quarter on quarter versus the last time here. This is higher than what the street was expecting. Why it's happened so? Primarily because the treasury income actually has been quite robust, and that hasn't picked up in fee income. So Vikram, loan growth looks good. NI basically is above the street estimate. Net profit is below street estimate. Fresh slippages are below street estimate. NPA actually overall is below street estimate.
Is it going to be a huge hit as far as this stock is concerned when trade opens up tomorrow? That remains to be seen. But Gaurang Shah, Geojet Financial Services, joining us, our old friend here at Business Television India. Great to have you with us. And Mayuresh Joshi is also on the line, fund manager at Angel Broking. Gentlemen, thanks so much for making time to discuss the numbers of ICICI Bank. Gaurang, coming to you first. How do the numbers look to you this time? Is it much worse than what was expected? Because that can be very negative for the stock.
Thanks, Vikram, and good evening to all of you all. If I have to put it in one line, it is not as ugly as I would have expected it to be. And possibly there is some amount of, green shoots that are visible. As Piyush was mentioning, net interest income has shown an uptick. Net interest, the margin from 3.14 to 3.24. More importantly, Street was working with a loss, but they have come out with a 1,100 crore profit. That's much more credible, and I hope there is no fine print or in between the line or one-time one-offs. If numbers are what they are, the stock wasn't green. Possibly the Street would have smelled before the numbers were out, but there is definitely signs of improvement. Not taking the fact that there is going to be a transition process, possibly at the leadership, needs to be seen what is the commentary over there. But as I see the numbers which are unfolding, they don't look as ugly as I would have estimated. Slippages, yes, from 4,300 crore odd to about 15,700 crores, thanks to the provisioning change that has been put in place. But they are not as scary as I thought it would be.
Yeah, fair enough. Look, as far as PAT is concerned, we were looking at the standalone number when we started out the breaking news. We're looking at a PAT of 1,142 crore rupees, which, as per our estimates, by that definition, 1,076 crores is what we were expecting, is slightly higher. So to that extent, yes, it doesn't look as bad like Gaurang is pointing out. Mayuresh, what do you make of the numbers as we see them right now? Though the slippages does raise some concerns, don't they?
Well, they do, Vikram, and thanks for having me on the show. But a large element in terms of the total domestic loan growth of 15%, within that component, retail loans have actually grown 21%, and now they constitute 57% of the overall loan portfolio. So I think that's one thing that the Street would ideally like to observe, the de-risking in terms of growing the retail loans much faster than the stressed out SME, MSME loans. Also, the CASA ratio at 51.7%, I think that's a very healthy ratio that one probably can look at. Gross NPAs, yes, I think slippage is a lot more worse than what the Street was probably penciling in at this point of time. But a large element is that a lot of these slippages, as I see from the notes, of 15,757 odd crores, 9,968 odd crores, are loans which were under RBI schemes, and they were classified as standard. So I think a majority of the slippages, in my opinion, would have flown through from the watch list. And again, one really needs to understand how much component in terms of the recognition has already happened this time around. So again, all in all, I think numbers were expected to be on the softer side. So the slippages number, obviously, it's worse off than what the Street was expecting. But the other numbers in terms of loan growth, in terms of what they've performed on the NIMs, the retail fee income, I think those are some encouraging signs that one can look at in these numbers.
Right, that's the view coming here. Gaurang, again, one sort of question here. Standalone, the number actually which I had highlighted on a consolidated basis, 1142. Vikram again just highlighted number here. If I look at the Street estimates, the average estimates, this number actually is almost 60 crores, more than 60 crores. I should say 6% higher than the Street estimate here. The Street estimates, the average estimates, this number actually is almost 60 crores, more than 60 crores. I should say 6% higher than the Street estimate here. If you remember what happened with Axis Bank again, what you think perhaps is going to be the focus of the street here when they look at the numbers here? Prima facie, NIMs have improved. They're slightly above street estimate here. Loan growth, again, there is no major sort of issue which is visible in the result numbers here. And again, if you look at the sort of NI number, fee income number, those are looking robust here. So broadly, is this result pleasing you, giving you some signs of improvement, or the slippages number actually are at present looking much higher? Net NPA number is around 4.77%, gross NPA 8.84%. Are they actually looking much lower than what you would have feared for?
So first, let me give a disclosure. We have been maintaining a positive coverage on Axis Bank for a very long time, even when over the last 3 to 4 quarters, numbers were looking as ugly as it could be. With today's numbers, I think 2 points that I would possibly highlight is the commentary from the management in terms of the slippages which have risen almost 4-fold or thereabouts. How are they going to take care of that? More importantly, I think what the street wants to hear is what is going to be happening in terms of the leadership. I don't know whether they will be speaking about it in the press conference today or not, but I think clarity on that will only comfort the uncertainty that lies with respect to this particular leadership and the vacuum thereof. On the numbers, like I was speaking to Vikram, well, I was expecting a much worse number, to be very honest. But it is not as worse. Only thing is, slippages, yes, there has been an uptick, but the good thing is that over the last 4 quarters, they have shown increase in the best interest income. Margins have also improved. They have reported a profit wherein large part of some of the participants that I spoke on the street, they were expecting a loss of double digits, but that has not happened. Detailed commentary in terms of how they are going to repair the existing balance sheet, I think that's going to be very, very important and crucial.
So with regard to the provisioning, Mayuresh, I just wanted you to highlight for us, how do you think this is going to pan out here on? Because as far as jewelry is concerned, that has gone up and it looks quite substantial from what Piyush was saying. How much of a concern would that be now going ahead from here?
No, so they have clearly classified that in their notes to account. So note number 11 is clearly demarcating the gems and jewelry exposure, the fund-based exposure of almost 794 odd crores, and what the provisioning has already been done and how much needs to be done. So in that sense, again, in my opinion, again, I think the kind of provisioning that they have done, more or less in line with what we were estimating at our end. And as Gaurang was also mentioning, I think the numbers probably have been on the softer side for the last few quarters. What they've probably done and what the management commentary will be in terms of the recognition, in terms of the exposure towards all these sub-segments. If a large element of that exposure has got recognized, my own sense is that it will all then boil down to the leadership changes that are expected to come through, or what clarity the management actually gives in terms of the leadership going ahead. And again, the large element in terms of the 4-fold jump that we saw in slippages, I think one can draw parallels, but one needs to really wait for the conference call to begin, whether the recognition, as is the case of Axis Bank, has largely been done by the bank in this quarter itself.
Right. So Mayuresh, in that sense, because both Gaurang and you again are saying numbers that you are not looking that bad here. So then let's talk about the sort of reaction again perhaps you could be expecting here. Because if I recall the Axis Bank result again, the street also actually said the same thing, that yes, perhaps a large reduction in watch list is actually positive for the future. So do you believe the street perhaps could be forward looking for Axis Bank also? Because all accounts again, NIs, NIM and also loan growth again, those actually are not showing any slowdown here. Broadly, if you look at the retail performance also again, that's looking good. So is it actually something which the street perhaps would be getting happy with the stock price here?
So twofold answer to your question, Piyush. On the other parameters except slippages, I think, as I mentioned earlier, it has been a very stellar performance. So retail loans have grown 21%. The NIMs have shown expansion. The retail fee income has also grown 16% and they have actually done pretty well in terms of constraining the operating expenses rise as well. So again, I think the slippages is one key factor that the street probably is focusing at this point of time. So the provisioning figure, as I said, more or less in line with what we were expecting. The additions to the gross NPAs, I think if the management is, as I said, confident enough and sufficiently tells the street that large element of this recognition has gone through in this quarter's numbers, my own sense is that markets and the street obviously are forward-looking, and with the kind of constitution of the retail book, which is around 57% for the year end 31st March, that number will keep on increasing, which gives confidence to the street, as I said, in terms of de-risking of that portfolio. So a large element in terms of asset quality recognition, if it is behind them, like we've seen in the case of Axis Bank, though too premature to call at this point of time, any commentary in the management con call, I think that would give some amount of respite to the street. So as Gaurav was mentioning as well, I think we also have a very clear disclaimer of being positive on the stock. And again, very frankly, I think on a price to book or a price to adjusted book parameter, I think it is still one of the cheapest private sector banking stocks.
While we continue to decode the numbers, at this point in time, what the street is going to watch very closely is the kind of commentary when it comes to management issues with Chanda Kochar and indeed the kind of controversies that the bank has been embroiled in. Hemendra Hazari, banking expert, is also joining us. Hemendra, we've heard that the government nominee has skipped that board meeting. How do you read it?
I think it's extremely disappointing for shareholders and the broader public and the depositors of ICICI Bank that on such a critical board meeting, the government director has chosen to be absent. Now, you should ask the government, why on earth do you have a nominee director on such an important meeting when the CEO is coming under very daily, press disclosures are coming out of her and her spouse's involvement in all kinds of murky transactions. Now, when the Prime Minister's office is now investigating and has told different government agencies to investigate her spouse's dealing, I think it is indeed shocking that the government director has chosen to be absent. I mean, what kind of government is this? We would expect the government director to have played a very lead role, because as we all know, independent directors are very rarely independent on the board. So therefore, I think it is a very big negative surprise. And as long as she continues to hold the post of CEO, there is going to be a Damocles sword over the bank and to shareholders. So I would have expected the government director to play a very lead role in seeing that she steps down.
Is it an indication then, Hemendra, that there will not be any commentary as such about the future of Chanda Kochar at the helm of ICICI Bank?
As of this moment, it appears so, because there's been nothing in the press release to indicate that she's going to step down. And this is for all to see how corporate governance is practiced in this country. That when the spouse of a bank CEO is, implicated in all types of deals, not only does the CEO, any self-respecting CEO would have stepped down long ago. When such a CEO does not step down, it is the onus is on the board of directors to compel the CEO to step down. Here, neither is the individual Mrs. Chanda Kochar stepping down, nor is the board putting any pressure. The fact the board is fully supporting her. So this is how corporate governance is. And it should be condemned by the analyst community and by the business media. But I very rarely see the analyst community even opening their mouths about such an issue.
Right, and indeed, we're watching that space very closely. As soon as the management starts speaking, we will get you that, and indeed the decoding is going to happen with all our experts in the house. But Piyush, we're also looking at the impact of the Feb 12 RBI circular. The amount is 9,968 crore rupees. If you can put that in perspective for us.
Well, Vikram, again, the street was expecting a number closer to around 10,000 crores. And that again was the number around fresh slippages, including of RBI circular impact, and in addition to that, the fresh slippages apart from that. Number is slightly higher than what the street was working with, but nevertheless, again, still, if you take a look at the entire NPA ratios, the gross NPA, net NPA, this number actually is lower than what the street was expecting with. So perhaps on NPA, I think it still looks actually much better than what the street was expecting. And I think the second question perhaps would be, and that I think that's what I think I want to ask Vikram to Mayuresh here. here is on NIMs again. At 3.24% NIMs for ICICI Bank, on one side we're talking about, yes, the net profit is higher than estimate, perhaps the NPA ratios are not looking as much bad as the street was expecting. But then, Mayuresh, the question here is that if I want to compare the two laggards, Axis Bank and ICICI Bank here, what's the feeling here? Around 57% as an exposure to the total retail loan as a part of total loan book here. How much NIMs can improve now? Because around 3.24% there is improvement, but already there is a high exposure to retail loan here. So between ICICI Bank, Axis Bank, what the street is going to prefer now?
A very difficult question to answer, Piyush. But frankly, I think the domestic net interest margin, as it reads to the notes of accounts, stood at 3.67% odd, and the overall NIM was 3.24%. So you're right, I think, with a larger pie of retail loans probably coming through, the NIM, specifically on the domestic part of their operations, looks very, very strong and steady. Similar is the case with Axis. The kind of retail loans and the de-risking of their portfolio is something which is going to provide support to their domestic NIMs. So to a large extent, they'll be able to sustain their NIMs, specifically in the case of ICICI Bank. But again, I think what probably happens also as a corollary to their retail loan growth is also the retail fee income. So again, retail fee income constitutes 75% of the total fee income. So I think the de-risking is working very well, both in terms of domestic advances getting reflected in strong retail loan growth, along with very strong CASA ratios, as well as the retail fee income, as I said, which is almost 3/4 of the total fee income. So yes, I think it's a strategy that both ICICI and Axis are following at this point of time, and it should work positively for them, apart from all the other issues that both these banks probably have in terms of the management bandwidth.
Right, then I have to ask you, are you going to prefer ICICI Bank over IndusInd Bank, Yes Bank? I will not ask you now on Axis Bank, but then is this performance, is this result enough to actually induce you into thinking about re-rating for the stock, or you think perhaps the light at the end of the tunnel is still some time away?
So was that for me, Piyush?
What I wanted to ask you was that, is this result enough now for you to actually take exposure in ICICI Bank versus IndusInd Bank or Yes Bank, or you think perhaps you need some more quarters or some more clarity, perhaps in the next 1 or 2 quarters?
So again, obviously what the clarity is required is in terms of the management bandwidth and what probably happens related to all the controversies that we are probably looking at. Purely from a numbers perspective, as I said, I think the retail growth is looking very, very steady. The slippages number, if one really accounts for the RBI impact on slippages, and they were on the higher side. But if there is some amount of clarity within the con call itself, that a large part of the recognition has happened, I think ICICI Bank should be reporting far more stable numbers going ahead. As far as your other question goes, considering the other banks, Yes Bank, again, stable and a solid set of numbers. We maintain a positive view on that stock. And within the retail private sector banks, IndusInd, HDFC Bank has given a very stable show. One might really argue that on a price-to-book parameter, these stocks are extremely overvalued, and they are very, very expensive at this point of time compared to the others. But I think the premium or the premiumization that these banks are deriving is based on all the core parameters that they are reporting. So I think the hold probably on retail private sector banks like an IndusInd and a HDFC Bank continues.
Also, Mayuresh, with the drill down list, we've seen them include loans that are internally classified as below investment grade as 19,000 crore rupees. That's what ICICI Bank has done. When I look at their loan growth, it is 21% in retail. Corporate would be around 10%, 15% year-on-year overall loan growth. Do you think the worst is over, and that there is, we heard from Gaurang, that there are these green shoots now, especially when you look at the loan growth story?
So Vikram, I think the overall picture has to be taken into consideration here. What probably happens in terms of the overall credit growth for the last 4 to 8 quarters was still languishing in higher single digits. So as the economy starts moving higher, and as large part of the recognition specifically in terms of the PSU stress that we've seen in the aftermath of the scams that have been brought to the forefront, you are going to see a gradual improvement happening in terms of the advances growth for the industry as a whole. The second element is one really needs to account for a gradual improvement in the overall advances growth. Now the private guys, whether they are the corporate guys who are also focusing more on retail loans or the core focused retail guys, I think they are probably going to gain market share in lieu of what the public sector banks might struggle over the next 2 to 3 quarters, to say the least, where their entire focus would be in terms of recoveries, upgrades, and probably getting their books in order. So in that sense, a lot of these retail banks, corporate banks like ICICI, where again I think the focus in terms of retail loan growth has been quite stellar, I think that might continue very well, and they have got supportive capital adequacies to fund their balance sheet expansion, which again the PSU banks do not enjoy at this point of time, both in terms of their tier 1 ratios as well as what is expected in terms of recapitalization to come through. So on both these parameters, as credit growth gradually starts improving, the private guys are going to grow in excess of the average credit growth seen in the system. So in that sense, I think that should hold good for them in terms of their overall balance sheet growth.
Fair enough. So, Mayuresh, you did a bit of a comparison for us when it came to the banks. How do you think the stock is going to move tomorrow when trade opens for business? And looking at all the options within the private banking space, how do you think ICICI Bank actually would be placed in the pecking order, according to you?
Well, clearly demarcate in terms of corporate banks and retail banks, specifically on the private banking front. So at least on the corporate banks, ICICI Bank looks better placed in our opinion, with the caveat that whatever comes through in terms of the management commentary and the con call, and again I think, as I said, the management bandwidth in terms of questions answered on all the controversies surrounding that, I think those are important aspects to be seen. But yes, ICICI Bank within the corporate space, retail banks is something that we will continue to like over a longer period of time. Within the retail banks, again, IndusInd Bank, HDFC Bank is something where our whole recommendations still continue, because our belief is the growth should continue, though the base at which and the pace at which they will probably grow might come back a little bit in terms of historical comparisons, but still they're growing at a very fast clip. And again, the asset quality stress is not that evident in terms of their balance sheets. And Yes Bank is something that we will also like from a long-term perspective. Stellar growth, they've already done the requisites that is required in terms of capital raising, when they need it or not over the next 2 to 3 quarters. But again, I think that provisioning has been done at their end. And the divergence numbers that they reported, along with strong advances growth numbers, the NIMs that they've reported, I think there are no complaints on that front. So I think these 4 banks or 5 banks are something that we will continue to be optimistic about within the retail space. Public sector banks, not largely at this point of time. I think there will be better opportunities for them to come.
Mayuresh, such a pleasure talking to you, and indeed I want to thank our guests, Hemendra Hazari, Gaurang Shah, for making time to discuss the fourth quarter numbers of ICICI Bank. Indeed, there will be much more to learn from the management speak, which will happen not too late. In fact, we won't have to wait too long, so we will come back to that in a moment here. But for this point in time, we can say this about ICICI Bank's fourth quarter numbers, that it isn't as bad as perhaps some quarters were expecting. In fact, the PAT, the consolidated number, has come in at 1,142 crore rupees as opposed to our estimates of 1,076 crore rupees. And we're watching the NIMs, we're seeing how the NIIs have panned out, and the picture doesn't look too bad at all. Of course, what happens in trade tomorrow is a space that we'll be watching very closely. But Piyush, thanks indeed for joining us with all that we have been able to discuss on the fourth quarter numbers of ICICI Bank. Much more to follow as soon as the management and Chandra Kochhar in particular starts to speak. Indeed, the future of the management remains something that is top of mind, and what the street will be watching very closely, as indeed we are. But for the moment, from all of us here on this breaking news piece on the fourth quarter numbers of ICICI Bank, bye-bye.